All right, let's talk about something that's on every investor's mind, hedging. It's this powerful, maybe a little misunderstood tool that people use to protect their portfolios when the market starts to get a little wild. So let's just dive right in.
I mean, who isn't, right? It's a question that keeps a lot of us up at night. You work so hard to build up your investments, and the idea that it could all take a nosedive, yeah, that can be pretty scary.
Because, when the market drops, it's not just some numbers on a screen. We're talking about your savings, your retirement, your future. So the big question is, what can you actually do about it? How do you prepare for that risk without just, selling everything and running for the hills? Well, that's where this idea of hedging really comes into play. Honestly, the best way to think about it is like insurance. It's portfolio insurance. You're basically paying a little bit of money up front to protect yourself from a potentially huge loss down the line. So here's the textbook definition. But the part you really got to focus on is that last phrase, rather than seeking outright profit. See, hedging isn't about getting rich quick. It's a purely defensive strategy. It's not about scoring touchdowns. It's about making sure the other team doesn't score on you. And this slide just nails that distinction. Investing? That's your offense, right? That's you trying to grow your money. Hedging is your defense. It's all about protecting what you've already built. And just like any insurance policy, that protection has a price. You have to pay a premium.
Okay, so all of that sounds great in theory, but what does it actually look like when you do it? Let's walk through a super common example, hedging with something called an S&P 500 put option.
So let's set the scene here. Imagine you've got $1 million portfolio and you're getting a little nervous about the next 3 months. So you decide to hedge. You buy what's called a put option. Just think of it like this. It gives you the right, but not the requirement, to sell your stocks at a predetermined price, even if the market completely tanks. And for this 3-month insurance policy, it costs you $20,000, which is about 2% of your portfolio. In this table, this is where you see the magic happen. Look at the top. If the market goes up, you're a little behind because you spent that 20 grand on insurance you didn't end up needing. But look what happens when things go south. The further the market falls, the better the hedge portfolio does. Well, I should say, the less it loses. And this is the punchline. Let's say the market drops 10%. Without a hedge, you're down 100 grand. Ouch. But with the hedge, your options actually start making money, which cancels out a big chunk of that loss. So even after you account for the $20,000 you paid for the hedge, your portfolio is only down 5.8%, or $58,000. That 20 grand premium just saved you an extra $42,000 in losses. That's the power of a good hedge.
But here's the really cool part. Buying those put options is just one tool in a massive toolbox. There are so many different ways to hedge, each one designed for a slightly different job.
And here's a little peek inside that toolbox. You've got the classic diversification, right? Don't put all your eggs in one basket. Simple, but effective. Then you get into more advanced stuff. A futures contract lets you lock in a price today for something way down the road. Short selling is where you're actively betting against an asset, hoping its price falls. An inverse ETF is kind of wild. It's a fund that's built to go up when the market goes down. A protective collar is a slick move where you get your insurance, but you pay for it by agreeing to give up some of your potential gains if the market soars. And then there's volatility hedging, where you're not even betting on which way the market goes. You're just betting on chaos itself.
But, and this is a big but, you got to remember that none of this stuff is simple or free. Hedging comes with real costs and, honestly, a pretty steep learning curve. There's a reason it's considered an advanced strategy. I mean, how complex are we talking? Well, get this. The math equation used to figure out the fair price for an option was so revolutionary that the guys who came up with it won a Nobel Prize. We're talking about some serious high-level brainpower just to figure out what that insurance should cost.
And yet, even with a Nobel-winning formula, traders have this great little saying. It perfectly captures how this stuff works in the real world. Basically, it means that the models are a fantastic starting point, but they're not perfect. Real traders are constantly tweaking things based on what's actually happening in the market. It's as much an art as it is a science.
So at the end of the day, it all boils down to this one question. What's more important to you? Squeezing out every last drop of performance or protecting what you have? Are you willing to pay for that peace of mind, knowing that it might actually cost you some gains if the market keeps going up? There's no right answer for everybody. But the smartest investors are the ones who've already figured out their answer long before the storm ever hits.